This is Justin Pulitzer. This is my weekend review for Sunday, June 26, 2016. A lot to cover. I'm going to dive right in. So we all know that we had the Brexit vote on Friday, and it went in favor of the British leaving the European Union. And the market had been, I guess, caught off sides. I think everyone had, or for the most, I shouldn't say everyone, but most people believed that there was not going to be a Brexit, and it wound up happening, and there wound up being quite a big spill in the markets. I guess the fear here with regard to the Brexit is that the EU is going to dissolve. I have often in past videos talked about thinking that the European Union was unsustainable. It was very hard, in my view, to see how linking monetary policy without linking governments could ever be sustainable over the long term. I think the fear here is that there's going to be an instant crumbling of all the EU. Seems unlikely. Britain was one of the kind of bailer-outer type of countries. I know that's not exactly the best English that I could use here. But, like, for example, Britain was contributing billions of dollars a year to fund, weaker periphery countries like Greece and so on and so forth. And I think that the British people just got sick of it. Sick of that type of redistribution. I don't really want to get into too much of the politics of it. I think most people know where I fall with regard to that, in that regard, but we'll get into the market and where I see things going from here. Anyway, I have a VIX key here. This is part of my 6 market keys. We are in, I'll tell you what's a little odd. We did close, it shows here a close on Friday of 25.76. But the regular trading hours at 4 o'clock was 24.52, below the key 25.20 level. Futures do trade for an extra 15 minutes after 4 o'clock, and they had quite a continuation in that regard afterwards. So I guess this was quite elevated. Anything over 25, of course, you can see here this was the flash crash, what led to the flash crash Monday. Any closes over 25, and I'm not necessarily going to say that this wasn't a close over 25. I'm just going to say it was close enough for government work here that that usually leads to more downside in the market and more elevation in the VIX. As long as this holds over this 25.20, the 31s are in play. Anything back below there can retreat a bit. The VIX did really what it was supposed to do on Friday. It opened high, came down quite low, and then steadily rallied throughout the day. The play I had talked about doing, if you were able to get them off that day, was selling same day out of the money S&P or SPY or whatever puts. I had platform issues that on Friday morning. Took me 3 or 4 attempts to boot my platform, and then there were delays. I wasn't able to, unfortunately, execute the trade, which is very frustrating, but it was the right one nonetheless. I love those big moves down, particularly on a Friday with same-day expiration. This could be in stocks as well. And the big spike in IV juices the puts that are far out of the money, that are unlikely to ever be reached. And selling those are basically, I don't want to say, let's just say that it's very high probability of success trading. Anyway, that's how I see the VIX. Anything that sustains above 25s can see 31s. Back below could probably see the 21s and 22s. So that is VIX. The dollar, of course, is soaring. This is I shouldn't say soaring, but it was up quite a lot on Friday. The fear here is that foreign companies that do business overseas, when they repatriate their money, they're not making as much. A weak dollar is better for that. A strong dollar isn't. And you had a big move in the dollar back into range. I've drawn in, we had this big run up in the dollar, and then we've have this sort of sideways trading action with moves above the upper end of the range being unsustainable and moves below being unsustainable, and now we are basically back into the range, coming into a big volume distribution. I would think it wouldn't be a stretch to see the upper end of the channel here and maybe the 200 MA, and then we can reevaluate there. So I would think that the dollar probably has a little bit more bounce in the ounce, so to speak. TLT, the bonds. So it's amazing how little a lot of people understand finance, or at least asset pricing, stock pricing. I went to business school. I majored in finance and marketing. I was a double major. And basically what I was taught in school was valuation. And the way we did that was with discounted cash flows. I don't want to get too into that, but the lower interest rates are, the higher PE multiple premium, the more you're willing to pay on earnings, even these ridiculously weak earnings that we've had out of the market. You know, the market is trading at, it depends on how you measure it, anywhere from 19 to 17 times earnings, which is a lot. A lot of people say that the market multiple is, correct market multiple is 15. I don't really subscribe to that theory. I just believe that anything below 10 is unsustainable to the downside, and anything above 20 becomes unsustainable to the upside. Markets tend to peak when interest rates are roughly about 6%. That's what happened in 2000 and 2007, and we are not even able to comfortably hold over 2%. We're in the ones. So, like I've said, the market deserves to trade at a premium with a lower than usual interest rate. It just doesn't like when it gets spiky, because people tend to thinking recession. But as long as this stays low, that's good for auto financing, which I've said I think is near peak, real estate, which is good, and of course the market. You just don't want to see spiky type of moves, but as long as this stays up here, this will provide a little bit of cover with regard to the PE multiple of the S&P 500. Think about it like this. If you're somebody who needs to live off of a fixed income or retiree or such, you're not going to really be able to put your money into CDs or annuities in the traditional sense, or I mean, I guess not so much in treasuries. I mean, if you want to talk about bubbles, this will probably in the end wind up being the biggest bubble of all time, but I don't want to get into that right now. It's not really relevant, but at least not for the next, foreseeable few months or maybe even years. But the point being is that these people are forced to put their money into the market, and if you look at like the stocks that rebounded the fastest on Friday, look at this. This was Philip Morris, Altria. This is sort of the Exxon Mobil of cigarettes. They opened on the low, rallied up pretty high, and still closed with a pretty solid day. So that's really what's going on here. Companies are getting multiple premiums. Of course, in the end, this all ends very badly, but the music can play quite a while as long as there is a chase on yield. Speaking of yield, one thing that I could say was a little bit of it depends on how you look at this. I guess this depends on really your worldview. The HYG did close below the 50 MA, but it didn't take out this swing low, and it rallied quite a bit and kind of closed better than the market. For a real problem to develop as far as crashes and things like that go, this is kind of what you want to see. You want to see this steadily down trending type of a move. You don't want to see, this type of chop or even up. Keep an eye on HYG. The 50 MA, the 200 MA up here was a lot of resistance. This is going to be a very key level. You can see there's a distribution here, and you have a 100 and a 200 MA. I am keeping my eye on that. Anything below the 200 and the 100 would, to me, get a little bit more suspicious. As long as it holds, I would say it's kind of quote-unquote okay. Oil. All right, so 49 is the key momentum level here. I've heard a lot of levels bandied about by people who really don't know what they're talking about. 49 to 50 is the key level. I'll even up it to 50 at this point, because we had this push up, and look where this stalled at 50.54. So the key here for me, and you can see it's actually trading. That's why this chart is like jumping around. I hate when that happens. The 50 MA here has been very key. The real key breakout was the 200. So if we lose the 50 in this swing low, this could pull back to as far as the 200 MA, wherever that is at the time. You can see we're below the channel. We have a lower high. It is possible that this does get smashed if there's an expectation of global growth slowing. Let's watch the 50. I like to take it level by level. I know a lot of people like to assume end ranges and assume, you know, just because we're getting close to something, it means it has to happen. I can't even tell you how many trades in my youth that I muffed because I anticipated. You kind of, even once in a while now, I'll get a little trigger happy, but I will often do it with smaller size. Yeah, this day here, this was obviously the Brexit vote. The low of that day, if you start getting below there, you probably don't want to be as long oil. If you can get back above that day, the 50.45, then I think you want to be long oil. I'm sort of going to treat this day, the Brexit day, as almost like I would a Fed day. A lot of people know how I look at the Fed day ranges. That's very key. And this also, by the way, didn't take out the last swing low or the 50. So 50 MA or bust, so to speak. That's really what we're looking at. So with regard to oil, a lot of people don't trade futures, or they like the USO, but I'm not a big fan of the USO because of contract roll. It's a very flawed instrument. You can use. I like the XLE. This kind of did better. Also, 50-day moving average hold, held trend, and closed a little bit stronger than the market. So we're kind of right on it here. Yeah. So we'll use that same kind of range. You can see the body of this is close to the body of this day if you don't want to use this entire wick. If you don't mind using that wick, you can use this low as the key, 65.34. If you want to be closer, you could use the 66.29, the Brexit day range. This also, let's see if we can go back to it. The 200 MA, look where this broke, and it kind of never saw it again. We broke out here. I've been expecting a 200 MA retest. It's never happened. If you want to play, like if this does snap more definitively, I like put ratios or put spreads or whatever, flies, however you want to play it for a move somewhere down to near the 200 MA, where I would think it could be a right or right out area, or if you want to sell some like 61 or 60 puts, which is like the halfback, really where this move started from. I like that idea. My favorite of, and I was even talking about it, I mean, I couldn't even control myself. I was talking about tobacco, and I just got so excited I had to talk about Exxon. Exxon is the kind of the Mac Daddy of the oil patch. It as soon as Thursday was at a 52-week high. We got a pullback right to the 50 MA. I would say somewhere between the 50 MA and the channel low at the very least here is probably a right or right out, at least for a day trade. If there is a snap, there could be a move back down into like the, well, let's see. We got the 87s. So like, for example, if there were to be a snap, I'd be interested in buying like the 87 puts and maybe selling like the 84 or 85 if there was any juice in there. I think that would be a good either a spread or a good ratio. That to me would be more of a winning trade. I like the idea of buying Exxon on weakness, though, particularly selling out of the money puts. The 200 MA is way below down here at 81.95, so this will probably wind up creeping up. If there's some kind of flash crash, and I'm not saying there will be, you want to be very aggressive early on, I think, with selling out of the money puts, particularly if there was like some kind of a really large gap down. That seems unlikely to me with Exxon, but hey, stranger things have happened. I'd be aggressive on that. That would probably be my first trade of the day if that were to happen on like Monday or whatever. China. All right, so China is still kind of holding trend. We'll have to see how this winds up playing out here. It closed on the 100 MA. It struggled to close above the 200 MA. It's doing some lower highs here. We haven't put in lower lows yet, but I'd probably, given that we're kind of coming down from the higher end of range, if we got somewhere around like 30-ish, somewhere between the 50, I shouldn't say the 50, the 61.8 and the 78.6, That would be quite a move from here, but I would be interested in doing put ratios, like buying these, buying these and selling 2 times out of the money here, or if you're on a short time frame, buying some here and then selling 2 times out of the money below here. I think that would probably be a good setup. A good one that I like to watch is this IBB. It's sort of a risk on, risk off type of a instrument. And it's been weak. I've talked about thinking that we could see 100% retracement down to the 207s or the 212s. Excuse me. Let me show you what I'm thinking here. All right, so we haven't quite snapped here. We're kind of coming into the lower end of range. This has been a bear flag. I've talked about it. And we had a break out of this kind of wedge. If this has follow through, I would think that it's probably tradable. I guess you had a bit of a bounce here. I would have liked to have seen this bounce come a little bit higher, like up to the 50 MA here for like a short, but it didn't. Just be mindful that it's coming down from the bottom. Down from the top a little bit, and you might get a bit of a false breakdown initially. This to me though arbors, it's sort of a harbinger for lower. I'll show you why. Gilead, which is kind of like one of the best followed stocks, actually broke the range on Friday. I had been trading this long with some short out of the money puts, very small size, a tester. You can see here you had a bit of a look below and fail, which rallied up, and I was close to being stopped out here. And then Friday, we had the snapperooski of the range. So my view is that this Gilead is probably it's either going to go lower, maybe significantly lower, like into the mid to low 70s, or it would be a false breakdown if it got back up over 82.25. Like if it were to open up and gap up on Monday, seems a little unlikely with where futures are now, but who knows where that'll be by the open. I'll get into that later, but if there were to be like a gap up over this could be buyable, because this to me would be another look below and fail, and you'd probably have a little bit of a bounce, at least short term. But Gilead is showing a little weakness. To me, it doesn't look like it's doing well. Celgene, not one I cover very often, but this one is kind of right on it. You're coming down into some lows. The flash crash low here was 92.98. I don't know why I have this level here, probably because of this reference low here. But we are coming down into that level, and this is sort of really where it needs to hold. If it snaps there, I think it's probably going to see the channel low and maybe down as far as this reference low. It might not happen right away, but you could easily, as crazy as it sounds, see 83s. A $10 move on a break there wouldn't, to me, be so out of the ordinary. So let's get into the major market indices, the S&P 500. So I want to show you a little bit of nuance. A lot of you know I talk about Friday closes that are below 204.12 have led to severe down moves. Look here, you had the move down. This was the flash crash. Then again, you had a close below here on a Friday, gap down. They tried to rally it. It stalled. Look where it stalled, 201.90. And look where we are near now. Just keep that in mind. That's also be a very key level. It's also around the 200 MA. We'll talk about that in a minute. There's a little bit of nuance here, though. The first and foremost is that we had a dividend paid out in SPY, so this has an extra $1.05 worth of weakness in it. I don't really want to focus too much on that. I like to focus on the level themselves, but the key here to me, and this was something I noticed actually Friday when I was watching the close. If you notice here, this Friday, the close below 204.12, it was also a day that broke the 200-day moving average. The same thing here. Friday broke the 200-day moving average, closed below 212, and then we all know how this played out. The subtle difference here is that we didn't have a Friday. We did have the Friday close below the 204.12. You can see, although this was almost a photo finish at the close, this just had a lot of late day dumping. It was pretty close to actually closing over it, but close is no cigar. The subtle difference, though, is that we did not close below the 200 MA. So this is going to be fascinating to see how this plays out on Monday. Like I said, I've seen the futures. They were down earlier. I had seen them down as much, anywhere from as little as 7 to as much as about 15. And currently, I believe they're down around like 13 or so, 14. This is going to be a very key level. If this breaks, I would think we could see the 197s as far as the 197s. I have a Fibonacci retracement drawn in here. I don't usually use the 38.2 on the way down. I kind of do on the bounce ways up. But I want to show you something. In last weekend's video, I took it out just because it was getting a little annoying. But I had said that we could be setting up for a larger head and shoulders pattern. And I had drawn in, I think, the oval here. We did come up here, and now we're down basically to the neckline. I don't necessarily view this as a head and shoulders just because look how much time this built out here. We didn't really build out a right shoulder. If we were to rally up, though, that to me could constitute a build out of the shoulder. What happened here is it usually, to me, at least augurs a little bit lower, though. And I'll discuss why. You can see that this day here was sort of a false dawn breakout. And it was to now a lower high, and now we have taken out the prior swing low. Look where the rally on Friday stalled. It was like at another range distribution level, the 206.76. Look where this all supported here. This was roughly around there. So the fact that we did get a rally and then came down, it's not maybe as oversold as it was as if we were to open of load, close lower, and then had the big gap down kind of on Monday. I think the playbook that most traders tend to use, as crazy as this sounds, I mean, it's a long time ago already, but the 1987 crash playbook, people have the theory that markets don't bottom on a Friday. I fully subscribe to that. And then they look for some more selling on like a Monday and Tuesday, maybe even Wednesday. Usually it's the quote-unquote turnaround Tuesday. This week should be a little weird, though, because it is the end of quarter. I don't know how that's going to play in. Either that is going to find some strength for some window dressing, or it's going to exacerbate the move down probably more than normal. I did a couple of back of the envelope, actually quite literally back of the envelope calculations. Anyone who has hung out in my apartment will see I have Xerox paper that I do the weekend review letter information on. Usually it's like mistake paper. I try to not be a waste, and then I use the backs of envelopes for bills and letters and stuff. I did a calculation. If this were to be, if you did want to just count this close enough for government work of a head and shoulders, that would be about a $9.74 move. And a completion of that pattern, you basically double the range, would take you to roughly the 61.8 Fibonacci level, which is 193. The actual number would be 193.04. The fib is 193.10. So if this really is to snap, you could get a move even that big. That is one measure to look at. I do think if this breaks and we do break the 200 on a closing basis and we do get below the 201.90, that to me is a really key level now. I do think we can see this range low in the 197s and potentially even lower. I don't know that it's going to happen like in a cascade like this week. We did have a underwater close. I think the VWAP on Friday on the ES was 20.42, and we closed like $2 or something below there, maybe even more. I mean, it was a pretty weak close, and now we have a gap down, and I'm assuming, unless we rally up into the morning, overnight inventory will be short again. It might be one of these, like a gap down and rally to kind of correct that. This here now, to me, is going to be the key level. The fact that we lost the 204.12, the 201.90, and the 200 MA, this is going to be what is on every trader's lips. Speaking of on every trader's lips, I was walking around I live in New York. I was walking around and I heard in restaurants and in bars, I heard a lot of people talking about Brexit. This isn't, I think that there is a lot of misunderstanding and a lot of fear that's out there. And what it's going to take about 2 years for that to be negotiated. My guess is it'll probably be extended, and by the 2 years is up, I mean, who even knows if it happens? That would be like the ultimate, right? It seems like there's a little bit of fear here. A couple of cautionary things that I notice in the chart. You have a lower high. These were poor highs, by the way. I wouldn't surprise me at some point if these get corrected with a market move higher, but they're probably not going to happen before. A little bit lower first. Lower high, now a lower low. That is troubling. If we start getting below these lows, it to me could get, quite slippery. Just be careful. I tend to like to buy markets when they're making higher lows and higher highs. This to me now, you have a wedge snap. It could be false. We could rally right back up. The expected move this week in SPY is $7. It's weird. The quarterly expiration, which is 4 DTE, is 736, and the one for 5 DT is like 715 or something. I have to take a look. I was looking in the platform. It was saying an $8.17 move. I'm just going to go by the 736s. That roughly takes you, if he were to make a move up from the close, to 210.49. A move down low would be to 195.77. A lot of people talk about that 195 level. It's been a key level here. Look, the close here was 195. This is sort of where all this action took place and where the breakout took root from. That's just my thinking, and those are the levels. So keep in mind, anything that remains below the 204.12 remains vulnerable. Back up firms a little bit, but anywhere below 201.90 gets even more vulnerable. Just keep those levels in mind. They are very key. IWM. All right, so we are out of the box again. IWM didn't close quite as bearishly as SPY, oddly enough, and we are still inside of a channel. Hey, this is so annoying when the chart freezes, and it is frozen. Anyway, my thinking here is that there could be a little more room down to the 200 and maybe even the channel low, which would be the 100 MA. Yeah, that's just sort of what I'm thinking, that this could have a little bit more room lower. I would be interested in probably some type of a right or right out play, at least for a day trade bounce there. If it breaks, you can, probably play right or right out short for a move here. I'd be interested in buying these puts and then selling like 2 times out of the money, maybe lower. I don't know what the IV on that will be like at the time, but that to me would make a lot of sense. Yeah, that's my view. I think it could potentially see the channel low. That's my view here. QQQ. One thing also with the IWM, people tend to like it when the dollar rallies a little because those tend to be more domestic type of companies. They do business in the U.S. The Qs. All right, so this to me has been a bit of a harbinger of some weakness here. We didn't make a higher high here like we did in the SPY move, so this had some relative weakness. We are right on it here. You have often heard me talk about 104, 105. We are basically right there with a little wiggle room to 103 because that's the 50% fib and a trend line from the flash crash low to the pullback low to, we'll see how that handles this low. We are below these lows, though, so now we have undercut the range and making some lower highs and lower lows, which has me a little bit, again, on edge and cautious. This here, to me, is going to be key. If this snaps, we'll probably see the 61.8 and maybe even down to as low as the 98s. We'll have to see how that works. Actually, let's talk about the box. What's the low end of the box? 99.36. All right, so that would make some sense to me if we were to see the lower end of the range here of this box, if this were to snap. So that's my thoughts. I'm just going to stick to the levels, watch the trend. If that snaps, we're vulnerable. If it holds, we could easily bounce a little bit more. We are back below this sort of unofficial regression line, though, that I've drawn in. The key to this really is going to be Apple. Let's see. All right. This never quite got the channel low, which I think would have been a better setup for Apple. You know how I often talk about the slingshot being kind of half-cocked? We didn't fully get there. This would coincide now, if it were to get down there, with the big 61.8 of the 85s. I'd be interested in selling some out-of-the-money puts there if we got there. This is at some key levels, though. 92 is the flash crash low. We are coming down from the top here in the hundreds, so it's starting to become quite a bit. I had talked about this day. I had tried to write out trade this day, and it just didn't feel right. This day kind of felt like a bit of a dirty diaper, and so did this. And I just took it off. Wound up being the right move. This is just messy. They don't have much of a catalyst. They got through the Worldwide Developer Conference. They have another quarter coming up here that is probably not going to be super duper great. There'll probably be a lot of fear into that. We'll see how this goes. If this rallies into this quarter, it's probably a short. If it dumps really hard in anticipation of it, it could be a shake and bake where, it gets bought up. That being said, the stock is kind of getting oversold. I don't know if I'd be as interested in shorting it down near, the reference support as I would be up here near where there was some reference resistance. Apple is very key, though. If we start losing, the 92s, and this level here, this could become a bit of a waterfall effect. So be a little bit careful. It's a stock a lot of funds own, and they could use to raise cash. It's very easy to sell Apple. Facebook, doing exactly what it should be doing. I know people hate to hear that because most people are really long and they chase Facebook, and they really don't have a great trade location. But 100 MA here has been key. It lost it. The big support is always the trend and the 200 MA. If there were to be a quick move down to the 200 MA and this range low, I will be an interested put seller. It could overshoot. This is the gap fill, the 108s. The reference low in the 200 MA is 106.61. Any move down there, I am an interested right or right out buyer with shares. If there's some kind of crazy gap below there, we'll reevaluate that. But if there is an RTH move down there, I'm a right or right out buyer, and at the very least, a right or right out put seller, given how far we've come down. I think, considering this came from a new all-time high, there will be interested buyers in the Facebook. Speaking of which, also, if this were to rally back up, this is going to be a key area, the 50 MA. That could be a good day trade, right or right out short, wherever it is. The 116s were a big area. You had a lot of consolidation up there. What was support becomes resistance, and if this were to happen quickly, I would be interested in a right or right out type of a play there, just for a day trade. The Netflix. Mind you, also, Facebook did hold over the 210.65. I just want to point, this is just one thing to point out, all is not lost here. It is a little bit below this channel I drew in, but it did close a little bit stronger than the market. That's key. Sorry, this is Netflix. What am I doing? The same thing is, the same thing is, I didn't type in Netflix, so that's okay. This is still Facebook. This is below here, so it is a little weak, but relative to the market, you're seeing there are some buyers that are coming in there, getting interested in buying some dips. Netflix, same kind of situation. Came down a lot from the top here. This was, of course, a key area. I've talked about 103.88 to 105. It is sold off quite a bit. We're below some earnings lows. Usually what happens is you'll come mid-range. This has come a little bit further. This kind of held where it needed to by the hair of its chinny chin, 188.21. The ideal scenario for me with this Netflix would be for this to come down and get a primary trend touch, particularly if it were ahead of earnings. That to me would set up for a good right or right out long. Like if this just kept on coming down. I don't think it's going to be that simple, but this to me is very key, this Friday range. If we give this up, this could also be a waterfall effect down to the 79s and maybe the trend. If you can get back above the 2-day high here, then I think you're going to rally back up probably to the channel top. That's just my my gut. Either one of those scenarios will be playable, by the way. A short below the 2-day low and a break of this range, or a move back up over the 2-day high. Google. I don't know why or how I can stress this to people more. Don't F with this stock until it is either up by the channel top for a short or down at the channel low for a long. It looks like we might be getting the channel low. Caveat, we're down to some reference support. This could bounce. I like put spreads or put ratios to play for a move down to kind of, we're in a down channel within an up channel. So I'm sorry, we're in a down channel within a down channel within an up channel, as crazy as that sounds. But I do think that this area here to me would be interesting, particularly with how fast we've come down. I like the idea of playing put ratios. The one caveat here is that the summer quarter for Google doesn't always tend to be the best. It tends to actually be pretty nastola, but there could be a play to be had here on a quick move down ahead of those numbers. We'll see how that plays out. I don't like to mess with Google while it is in range. Look at all this chop. This is just very messy, very sloppy, and I don't really feel that I or anyone else, for that matter, have much of an edge in that name. Tesla. All right, so Elon Musk kind of jumped the shark a little bit with this Solar City buy. Oddly enough, Tesla had a lot of relative strength on Friday. Why? It got right to the 61.8 and right to the flat. What am I talking about? Flash crash low. Right to this gap fill level. This old gap fill level. The flash crash low was here, 195, but I like this 191 area. Also because it coincided with the 190. If you want to play this long, this has to be the stop, really kind of has to be the stop, maybe with a little bit of give to this channel low. I was actually hoping this day was going to gap down to the channel low and set up for a right or right out buy. It didn't, obviously. This area, though, to me is very key. Anything below there could get real slippery. I do suspect, though, that there is going to be some type of a rally back after we get the move to the channel low in Tesla, just because it came down a lot here, didn't get much of a bounce here, and then is down again a lot, and it's a heavily shorted stock. I'm sure Elon Musk, and summer does, believe it or not, tend to be a good period for Tesla. So this should be an interesting level for me, at least for a right or right out trade. The Priceline. So I had people messaging me about this on this day. Should we play the breakout for the gap fill here? I said I thought it was a little iffy. I wanted to wait till Brexit. At the very least, do smaller size. That turned out to be kind of prescient. We did get above here, and then we had this big bearish gapping day down into some reference levels. Look where the 61.8 comes into play. Down at 11:22.09. You have the gap fill at 11:10.68. I like this play for like maybe some put ratios or some spreads or flies or some kind of a play for a move down here. I wouldn't even mind selling some strangles or some condors. I think that could be playable. This is right nearing the support, so it wouldn't surprise me if there's some type of a bounce. I mean, this is technically day one of a big breakdown, and it took out a lot of days. It just doesn't seem to me prudent to short a stock that was down $158. I would wait at least for a bounce, and then I would maybe put on the spread if you're going to do it that way. If you're going to do the ratio, you of course want to do that into weakness. The spreads into bounce, ratios into weakness, because the IV expands. You're technically short more puts than you're long, and you always want to be selling premium into the down moves and buying it, if you're playing for a short, into some bounces. Anyway, that's kind of what's setting up here. This to me looks like a failed breakout, and now we may have some kind of an attempt at a breakdown. Chipotle. So this stock we all know has been a bit of a mess. However, a lot of we had the trend, we had the snap. We're now kind of getting a bit of a check back. There is a roughly equal 2-day range here. If we get a move over the 2-day high, I like it for a right or right out long for a move to the descending trend line, and roughly around 432, 33, right up in here. If you lose the 2-day low below the 393.20, then I like it for a short, for a move lower. We're coming into some reference levels. This could be you could start getting a little bit of some reference buys, but I'm just using this 2-day range. Above is a long, below is a short. And I will end on JetBlue. So I talked about this being a right or right out trade on the trend line or a move over the high of day of this day. Instead, we got a bit of a breakdown. You have, depending on what time horizon you're on here, you're into 261.8s and some reference levels. Even though you have a trend snap, it wouldn't surprise me to see some type of bounce. If not, we're probably going down to the 13s and maybe even 12s. 12, what is this, the high here? The 1282, somewhere between 1282 and 1360. That would be my view. You have a primary trend down in 9s. Don't put it, if we get into a real nasty bear market and there's some junky earnings, could see the primary trend. This is really a secondary trend. It should be in yellow. That's my bad, but we fixed it. Anyway, this needs to get back up over this. This could be a look below and fail. If there were, again, a move up over the 1602, I would be an interested right or right out trade for like a look below and fail. If this keeps coming down, 13s into there and then 9s, I mean, that's quite a move. I think it would take earnings to get it this low, particularly after such a protracted decline. Wouldn't even surprise me to see some type of a bounce before the earnings. And then, could set up for a day trade right or right out short, maybe mid-range here and onto the primary trend. Anyway, that's my story. I'm sticking to it. If the key, as stocks move up, I always say they're in actualizer mode, meaning, there's room for individual stories. When markets tend to go down, correlations tend to get closer to 1, and everything kind of moves together. Anyway, that's my story. I'm sticking to it. If you're not following me on Facebook, my handle is @JustinPulitzer. If you like this video, please hit the thumbs up. I always love comments to help me make the videos better. And if you're not subscribed, hit the subscribe button. You'll get notifications when I post new videos. Anyway, let's have a good week, and cheers.